Have you ever wondered why some people seem to grow their money steadily over time while others make fast money but lose it just as quickly? Today, we're going to explore the difference between long-term investing and short-term trading. By the end of this video, you'll understand which approach might work best for you, how the pros do it, and why your money behaves differently depending on your strategy. What is long-term investing? Long-term investing is all about patience. Imagine planting a tree today and watching it grow over years, even decades. You water it, give it sunlight, and let it grow without constantly digging it up to see how it's doing. That's exactly how long-term investing works. You buy stocks, bonds, or other assets and hold on to them for years, sometimes even decades. The magic of long-term investing lies in compounding. Compounding is like a snowball rolling down a hill. It starts small, but as it rolls, it gathers more snow, growing faster and faster. Your investments earn returns, and then those returns earn more returns. Over time, this can turn a small investment into a substantial sum. Long-term investing is generally less stressful because you're not worried about daily price changes. Markets go up and down, sometimes dramatically, but over the long term, they tend to grow. The S&P 500, for example, has historically returned around 10% per year over the past century. That doesn't mean it's a straight line, but if you stay invested, chances are good your money will grow. Benefits of long-term investing: lower risk of big losses. Because you're holding investments for years, short-term market dips are less concerning. Compounding growth: time allows your investments to grow exponentially. Less stress and time-consuming. You don't need to constantly monitor your portfolio or react to daily market swings. Tax advantages: many countries offer lower taxes on long-term capital gains compared to short-term profits. What is short-term trading? Now let's switch gears. Short-term trading is like riding waves at the beach. You try to catch the perfect wave and ride it for a short period before jumping off and catching the next one. Traders buy and sell stocks, options, or other assets in a matter of days, hours, or even minutes, aiming to profit from small price movements. Short-term trading is exciting, but it's risky. Prices can swing dramatically in a single day due to news, market sentiment, or even rumors. Traders use strategies, charts, and technical analysis to predict these moves. Some succeed, but many don't, especially beginners who underestimate the risks. Benefits of short-term trading: potential for fast profits. If your timing is right, you can make money quickly. Opportunities in volatile markets. Traders can profit even when the market is going down. Active involvement. You control every trade, which can feel empowering. Risks of short-term trading: high risk. You can lose money just as fast as you make it. Time-consuming. You need to constantly watch the market, analyze charts, and react quickly. Emotional stress. Seeing prices fluctuate constantly can lead to panic selling or rash decisions. High fees. Frequent trading can lead to higher commissions and taxes. Key differences between long-term investing and short-term trading. Let's break it down in simple terms. Time horizon. Long-term investors think in years or decades. Traders think in minutes, hours, or days. Risk level. Long-term investing is generally safer because time smooths out market volatility. Trading is riskier due to short-term price swings. Effort and attention. Long-term investing requires research at the beginning, but after that, you can mostly set it and forget it. Trading requires constant attention and decision-making. Emotional impact. Investors benefit from patience and discipline. Traders often face emotional highs and lows due to daily market movements. Potential returns. Long-term investing grows steadily thanks to compounding and market trends. Trading can offer big returns quickly, but losses can also be large and sudden. Which one is right for you? This depends on your goals, personality, and lifestyle. If you want steady growth, prefer less stress, and are building wealth for retirement or long-term goals, long-term investing is likely better. Even if the market dips, you have the time to recover. If you enjoy risk, have time to watch markets daily, and can handle emotional ups and downs, short-term trading might be appealing. But you must be disciplined, strategic, and prepared to accept losses. How to combine both strategies. You don't have to pick only one. Some people use a combination approach. Core long-term investments. This could be index funds, ETFs, or blue-chip stocks that form the foundation of your wealth. Small trading portion. A small portion of your portfolio can be used for short-term trades if you want to take advantage of market swings. This way, you benefit from the steady growth of long-term investments while also exploring the excitement of trading without risking your financial security. Tips for successful long-term investing. Start early. Time is your greatest ally in compounding. Diversify. Don't put all your money into one stock or asset. Spread it across different sectors and types of investments. Stay disciplined. Avoid reacting to short-term market fear or hype. Reinvest earnings. Let dividends and returns grow your investment further. Tips for successful short-term trading. Have a clear strategy. Know when to buy, sell, and cut losses. Use risk management. Never risk more than you can afford to lose on a single trade. Keep learning. Markets change constantly, so stay informed. Manage emotions. Stick to your plan and avoid making decisions based on fear or greed. Common mistakes to avoid. For investors, trying to time the market, reacting to every news story, or ignoring diversification. For traders, overtrading, chasing losses, and ignoring risk management. The psychological side of money. Your mindset matters. Long-term investors thrive on patience, discipline, and the confidence that markets grow over time. Traders need quick thinking, emotional control, and the ability to accept losses without panic. Understanding your personality can help you choose the right path or balance both strategies effectively. Real-life examples. Think about Warren Buffett, one of the greatest investors of all time. He buys companies with strong fundamentals and holds them for decades. His approach shows how patience and smart long-term decisions can grow massive wealth. On the other hand, some traders make millions in a single day by spotting short-term market trends. But many beginners also lose money fast because timing is tricky and the market is unpredictable. Whether you choose long-term investing, short-term trading, or a combination, the key is understanding the risks, rewards, and time commitment of each approach. Knowledge, discipline, and patience are your best tools. Money grows when you respect the strategy you choose and stick with it. If you found this video helpful, make sure to like it, subscribe to our channel for more finance explainer videos, share it with your friends who want to understand how money grows, and comment below your thoughts or which approach you prefer. Long-term investing or short-term trading. Now is the perfect time to choose your approach and start learning about it. Take small steps today. Explore the strategies that interest you and practice what you learn. Your future self will thank you for the actions you take now, because every bit of knowledge and effort you invest today compounds over time, just like your money.